Welcome back to the channel. Tune in or ghost out. If I sound sick to you guys right now, it's because I am. I've been trying to recover from this for a couple days now, but I promised I would talk about the market as we go into the new year and give some thoughts on what I think is going to happen. So I'm going to stick to that and push through the cold that's been going around. Apologize for my voice in advance, but let's get right into it. The number one thing you're going to have to watch out for in 2026 is definitely going to be volatility. In the first half of 2025, the US dollar lost about 10% of its value. This is the largest first half decline since 1973, largely attributed to tariffs and what happened on Liberty Day. While it did slightly pick up in the middle of the year, we are still ending this year off with a 10% loss in value, and that loss in value is really shown when you compare it to the yen or the euro, but you don't need to know any of this to feel the effects of what that means. As you've noticed, even though they say things are slowing down and not inflating as much, you are still seeing rising prices. While that is inflation, it is mainly your buying power going down because the dollar is going down. This is not rocket science. Many people know this, and this is why they don't like to hold on to dollars. But why is this happening? Many people thought that because we're not doing QE anymore and we were in a state of quantitative tightening, that the money would start to maybe gain value, but really we never stopped printing money. While we never printed it as much as we did during the big boom, the system that the Fed has created requires them to continuously put money or print money, which makes your money worth less. Just recently, we had the Fed do a $16 billion overnight repo on the 29th. That is the second biggest since COVID. And while overnight repos are not quantitative easing, but rather just temporary liquidity for the market, this has been a repeated pattern, especially in the later half of 2025. The Fed has had to have their hands so deep into the system to keep it running. It makes you wonder, how long can this go? But if you're somebody who puts your money into the markets, what does this mean for you? Well, many people might say it's a great thing because when the Fed pumps money into the system, people who hold assets benefit. And while that will always stay true, the amount you benefit will change depending on the situation. I think for a lot of people, investing has been somewhat of a easy concept. Since the pandemic, we've seen the stock market have the biggest crashes and the fastest rallies in history. And that is kind of what has my eyebrows raised for what's coming up next year. We know that we're getting a new Fed chair that is not Jerome Powell. While I'm not very confident in who Trump's going to pick, I'm not a fan of Jerome Powell. He is somebody who has been very late on every single call and has admitted several times that he's trying to make decisions on old information, but does nothing to gather new information because the Fed is truly not meant to make things go well. They're meant to make the system run as usual. And that system for a very long time has been to devalue the dollar to pay back and gain debt. Well, the person that comes in after Jerome Powell is probably going to be his polar opposite. Trump has already said whoever he appoints will be cutting interest rates to maybe all-time lows again. That will mean inflation, that will mean asset owners will benefit heavily, or that is what is expected. You have a new report coming out that most of the market predictors are very bullish on 2026, and when I see things like this in my head, I just think, this is a black swan event. This is the same thing that happened in 2022 before the crash. I just checked because I wanted to make sure, because I had an itching suspicion that the same thing happened in 2008, and guess what? It did. I found an article from Reuters saying that the S&P 500 was expected to hit 1700 by the end of 2008, which would have been an 11% upside for the year, but instead what we got was a negative 38% return that year, and a bear market that saw the collapse of Lehman Brothers and the start of the global financial crisis. Obviously times are different, the market is different, but this leads me into my point that the returns that you might see next year will not be the 10% that you're used to or are expecting. The average that you hear about is a single number. In actuality, the market is very volatile. These estimates usually assume that you are taking dividends and reinvesting to boost your returns, and a lot of times they take a long-term outlook. But when you break it up year by year, they're very unpredictable. In 2025, the S&P saw about a 19% return, which is historical. I'm not going to take anything away from it, largely because of AI, and AI will be the determining factor in how much return it produces next year. Since we are at all-time highs and PE ratios that are almost of that of the dot-com bubble, the AI industry is going to have to hit everything out of the park, and even non-AI things like the SpaceX IPO, everything that happens to the market in 2026 will have little room for error. That means earning reports from the major players are going to be critical. The small small startup IPOs that come from the AI industry will also be very critical. If those go under, that will send a bad message for what's to come, because that is the market's liquidity. If it's not going to those small players, then it's not going anywhere else. And because stock market at the end of the day has become very speculative, everything can burn down by just a couple bad days and bad sentiment. And if you know what 2026 has in store, it is filled with bad news. I'm sorry to say that, but a lot of debt is maturing in 2026, and coming up within January even, we have the risk of another government shutdown. Many people assumed once it resumed back in November that it was just dealt with, but they never really fixed the problem. And things like this are exactly what is leading into the rally of precious metals. I hate to do I told you so, because I really didn't tell you anything. If you had your eyes open, you would have saw the hype around gold and silver all the way back in September. At that point in time, gold was sitting at $3,700 and silver was sitting around $35. Many people made fun of metals and saw no value in them, even though the Romans and ancient societies have been using them because they're the only thing that actually makes sense to have. I'm sorry, sometimes you gotta talk to the fiat brain in a way that they'll understand. But since then, silver has hit a price of $74 at the current time of recording, and gold is sitting at $4,300. And this is not including copper or platinum, which both have hit all-time highs at this point too. As the world gets more volatile outside of the US system, precious metals will only continue to increase, because outside of the dollar, these precious metals are the global currency. That is until the shekel becomes the global currency. And while the metal markets are rallying like a crypto right now, which can't be said for Bitcoin, this usually is the signal before the crash. So given all this news, what can you do to protect yourself going into the new year? Well, that depends on what your goals are going into the new year. If you are a safe investor and you just want to do what is required to be good in your future, aka a long-term view of things, then it's still the same. Dollar cost average into the index funds, into the markets, make your investments automated. These are gonna be your vital lifelines to your future self. This is a mindset you should have in the best of times and in the worst of times. This is like investing 101. I don't want to beat a dead horse, but you guys know the basics. Now, for keeping up with inflation and seeing returns, even if the S&P or your index fund doesn't perform, is going to require you to be a lot more in depth with your trading. And actually, I don't even want to call it trading, because that implies that you're day trading or in the markets 24/7, and I don't think you need to do that. But I do think that 2026 will heavily benefit people who are actively investing, who are keeping up with the news, watching the markets, and seeing what might be the next big thing. This doesn't mean chasing hype, but this does mean following the narratives that shape the market. For example, many people are talking about the memory shortage that we are going to be facing in 2025 due to all the AI companies buying up all the memory, the RAM. And while this is making its way into the headlines now, many people already knew this going into 2025 and invested heavily into computer memory manufacturers. And those stocks actually did the best this year. And I will say this is a very hard game to play, because you never know when you're investing into hype or something real. But usually hype is filled with a lot of delusion, a lot of what ifs, whereas things that are real are tangible. They're very seeable. They're backed up by contracts. And I know this doesn't sound like fun. I do recommend the passive way of investing still, but active investing is never something bad. The more you can be up to date and learn about the market will never really hurt you, and in a lot of times may even save you. People will always tell you not to predict the market, which is 100% true, because you'll miss any returns that you could have had, or you'll lose everything waiting on for it to crash. But keeping up to date with the market is not the same thing as predicting it. You have eyeballs, you have a brain, and you can make conclusions based on the information that you have. And sometimes when there's a million red flags, then you can kind of see what's going to happen. But if you keep your eyes shut to the red flags and wait for them to tell you what's going to happen, you're going to be down a lot of money. And even if you do take a passive approach to investing, I would say keep track of the trends. For instance, if you weren't in the rally for the precious metals, understand why these precious metals are rallying in the first place. One thing about investing is that the knowledge that you gain every cycle is not able to be seen on a return sheet, but is rather like hitting a prestige in a Call of Duty. You get a new badge, but the grind is still the same. You're just a little bit more prepared this time. But again, what do I know? I'm just an unemployed guy playing Call of Duty, sharing my opinion. Do you agree or disagree? Let me know down below in the comments. I do read the comments. Do you think 2026 is going to be nothing but green, or should I get my cardboard sign ready? If you haven't already, like and subscribe to join the thread. And with that being said, thank you for tuning in. Until next time.
Take another day.